All right, so let's take a second to talk about diversification. We all know it's very important to have a well-diverse portfolio, but is there a point where you could be considered too diverse? All right, before we get started, make sure to give this video a like. Hey guys, my name is Keith Frislid, and today I'm going to show you what professionals think to be the magic number of stocks that you should have. So before we even get into that, why is diversification important? We all have a pretty good understanding of it, but just look at this real quick example. Let's say the date is July 6th, 2010. That's the day when Tesla had its IPO. And let's pretend you had $1,000 that you want to invest into a car company. Two car companies that come to mind are Tesla and Ford. So if we look at Ford, back then it was $10.46 to buy one share. Let's say you put all $1,000 into that stock. Fast forward 10 years later, the stock is now $4.82. You have lost over half your position that you put in. You put in $1,000, now you're left with $461. Bad investment. Let's jump over to Tesla. When Tesla IPO'd, it was $17.40. After those 10 years, or just about 10 years, that $1,000 would have turned to $42,657, with the stock now being $742 as I'm recording this. Now that's a massive jump, and that would be a much better investment. But no one would be crazy enough to put all their eggs into one basket. So what a sane person would do would be maybe to invest in both Ford and Tesla. Because back then, no one knew Tesla would explode to this price. And no one could have guessed that Ford would have continued to go down like this. You can't predict the future. So what happens if you took that $1,000 and split it between the two companies? As you can see here, you would buy around 47 shares of Ford, 28 shares of Tesla, and after that 10 years, that $1,000 would grow to $21,580. That's not as good as that $42,000 mark, but that's still an incredible return. And that's the point of diversification. You don't put all your eggs into one basket, you scatter them throughout the market, throughout maybe a sector or an industry. But you see all these people on YouTube showing their portfolios and they have hundreds of stocks. Is it really worth it? What's the point of having 99 stocks or 100 stocks? Is that really doing you any justice? So here's what the professionals say, who are much smarter than me. As you can see in this chart, as you buy more stocks, the risk of your portfolio goes down. That's how diversification works. And it looks like the magic number is around 20 stocks. As soon as you buy into 20 stocks, your level of risk is pretty equal to if you were to just buy into an index fund that had 500 some odd stocks. There's no point of really having 50, 60, 70 stocks. That's not doing yourself any justice. You might as well just put your money into an ETF or mutual fund. I'd put it into an ETF, but that's for another video. So when you see these people showing, well, I now have 100 stocks, it's gonna make me a lot of money, it's better than if you were to put into an ETF, it's really not. And don't take it from me. Let's take it from the legend himself, Warren Buffett. He said back in about 1967 or 1976, diversification is protection against ignorance. It makes little sense if you know what you're doing. Pretty much what he's saying here is if you know companies are gonna do well, if you've studied them inside and out, there's no reason to have hundreds of positions. And Warren Buffett practices what he preaches. If we look at this is a breakdown of Berkshire Hathaway as of December 31st, 2019. Just about 74% of Berkshire Hathaway which is Warren Buffett's company, is made up of 6 stocks. Apple being about 30%, then Bank of America, Coca-Cola, American Express, Wells Fargo, and Kraft Heinz. So you have 6 companies that is making most of Berkshire Hathaway's returns. That other 26 is about 35 to 45 other smaller companies or smaller positions that only have maybe 1 or 2% stake in Berkshire Hathaway. So when you're sitting down and trying to figure out how diverse you should be, if you should have a really diverse portfolio or maybe a more concentrated portfolio, the more concentrated portfolio might give you a better return than a more diverse portfolio. And at the end of the day, said by Warren Buffett and a bunch of other professionals, that more diverse portfolio, you're wasting your time. You might as well just buy it into an ETF and you'll get pretty much the same returns. Now just know, with the more concentrated portfolio, there's no promise that you're gonna know which stocks are the best stocks. You might have a lot of losers in here, and now you are more susceptible to more risk. But as we saw on the chart before, that magic number is about 20. As soon as you have 20, then you should be around just as diverse and exposed to just as much risk as if you were to invest into one of the major ETFs that has hundreds of stocks in it. So let me know your thoughts. What do you think is the magic number? What do you feel comfortable with holding on to? Are you someone that would rather have hundreds of stocks or maybe an ETF? Or do you try to go for this more concentrated approach? Me personally, I try to stay under that 20 stock number. I don't want to go below 15 because I don't want to be too exposed to risk, but I think between 15 and 20 is at least my magic number. So again, put in the comments what you think your magic number is. What are your thoughts on all of this? And if you like this video, give it a thumbs up. If you haven't already, hit subscribe. I'll see you in the next one.